What kind of world is this going to be?
Gold or
Well,
dollars?
no, this is the price of gold because Rafi is saying he sees it above 6,000 before the end of the year.
Silver is what you want to deal in for day-to-day transactions, but there'll be plenty of people who will swap gold for silver or silver for gold because gold is the way you're going to store large chunks of value. And so that's the first thing. And the second thing is, Mario, the question was, how much gold do you need in a hyperinflation? If we go into a hyperinflation, it's likely that gold will, relatively speaking, acquire a lot more value faster than other things which are rising in price because the demand for a highly liquid asset which holds its own against inflation is going to be directed towards gold. So gold will, relatively speaking, in a hyperinflationary environment, be able to buy you a lot of things, a lot more than you can buy today with gold. So
Sovereign debt markets are approaching a critical breaking point as government bond issuance rapidly overwhelms global investor appetite. When debt supply dramatically outpaces economic growth, bond prices tumble and yields spike violently. Macroeconomic commentator Mario Innecco and seasoned financial analyst Clive Thompson caution that central banks will soon be forced to intervene in this unraveling sovereign debt crisis. They predict monetary authorities will crack and roll out aggressive quantitative easing as early as mid to late September. This massive liquidity injection is expected to unleash absolute chaos across currency markets, driving gold prices past $6,000 before the end of the year. In this environment, physical silver will handle everyday transactions, while gold protects large pools of capital. Furthermore, precious metals mining stocks are forecasted to deliver exceptional returns as rising metal prices outstrip operating expenses and energy overhead. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you and enjoy the video.
I'm going to just share something, and Clive, you can answer that question Rafi just made. What kind of world is this going to be?
gold or
Well,
dollars?
no, this is the price of gold because Rafi is saying he sees it above 6,000 before the end of the year. And I drew this chart because it's a weekly chart, and there's a good trend here, channel. We broke out of it last year and stayed above it, and then we had the massive spike early this year, and then came back down onto that trend line, and then it broke down. So it looks like it's a false breakdown, and now we're back above it. So, Clive, what kind of world do you think we would have if we had, I mean, the bond bear market, I think, started in 2021. So we've already had 5 years of it.
Um, so, first of all, there's no doubt in my mind that due to the increasing level of government debt and therefore extra supply, the supply increasing faster than GDP, we will enter a world where the supply of bonds from the government exceeds the demand, and therefore the prices will go down and the yields will go up. Obviously, at some point, the Federal Reserve will probably step in. Now, the Federal Reserve, of course, will claim independence. They're not told what to do by the government. Their responsibility is to keep inflation in check and stand firm and keep full employment. But I think that realistically speaking, they're going to crack and they're going to start buying government bonds. And when that does, they won't call it quantitative easing like they did last time. They'll give it some other name. But I think that quantitative easing is coming down the line. And when that happens, all hell will break loose in the gold market. Putting timing on that, I'm going to say it could come as early as mid to late September. The question of whether gold goes above 6,000 is to some extent dependent on what the stock market does. If we have a generalized sell-off in stocks, and there's not really a huge sign of that happening yet. But if we have a generalized sell-off in stocks, people are going to be looking around for alternatives. Then I think gold can really fly.
Yeah.
But there's no certainty yet that stocks are about. They're expensive. They're very expensive. But expensive doesn't mean to say you have a sell-off. I mean, that's not historically proven. What it means is you have lower returns going forwards. Silver is what you want to deal in for day-to-day transactions, but there'll be plenty of people who will swap gold for silver or silver for gold, because gold is the way you're going to store large chunks of value. And so that's the first thing. The second thing is, Mario, or the question was, how much gold do you need in a hyperinflation? If we go into a hyperinflation, it's likely that gold will, relatively speaking, acquire a lot more value faster than other things which are rising in price, because the demand for a highly liquid asset which holds its own against inflation is going to be directed towards gold. So gold will, relatively speaking, in a hyperinflationary environment, be able to buy you a lot of things, a lot more than you can buy today with gold. So my answer to that is, if we go into a hyperinflationary environment, you want to have as much gold as you possibly can, because you are going to be able to buy some absolutely fantastic assets that you can't afford to buy with the gold you've got today, because those assets will be on sale because other people will want the gold. The miners obviously are selling something that everybody wants, but I suppose the miners' share prices will do very well, because the price of gold and silver is likely to rise much faster than they actually have to increase their costs. Of course, their costs will be going up rapidly too, energy costs and manpower costs. But realistically speaking, the lead, when we have inflation, the thing which leads is going to be gold. It always has been, always will be. So gold will lead, and so the miners will do very well, because the gold price will be expanding faster than their costs are expanding. Therefore, the difference between the buying set price and the selling price will be expanding. So yes, the share prices should do amazingly well. On the topic of hyperinflation, I interviewed somebody on my channel, Gregor Kovic from Yugoslavia, who'd lived through the 1980s inflation. And it started off very slowly at 10 or 15%, then quickly went to 100, then 200, then 300. But this was over several years. And then, of course, it finally went out of control. But he described a story where his mother had been able to pay off her mortgage, because salaries were rising as well with the inflation. She'd been able to pay off her mortgage. It was a fixed term mortgage. When it matured, it took her less than 1 month's salary to pay off the entirety of her mortgage. And that was because the prices and the salaries had risen so much. And I think, we could easily get into that situation if the central banks are forced to intervene in the bond market and start printing money like crazy, because the spending isn't about to stop. And obviously, with the yields going up, it's costing governments more and more to refinance that debt.
Yeah, and the bad thing about hyperinflation in our current environment is that uh, so many people depend on the government handouts to survive. And it's maybe, Rafi, yeah, that's going to be a world that's going to be pretty extreme. I think I was looking in the UK, about 30 million people that, or yeah, depend on the government in one way or the other for their livelihood. And well, that's like almost 50% of the population, a bit less, but it's quite significant. And I think in the US as well, a lot of people depend on the unfunded liabilities like Medicaid, Medicare, and Social Security.
I did some number crunching on the Bureau of Labor Statistics numbers, and it is quite clear that over the last few years, the population of the United States has been going up, but the number of people actually working, despite all these wonderful jobs numbers, is actually going down. So we have a smaller number of working population, effectively supporting a larger population of people who are not working. And we're not talking about the unemployment figures, which don't count a lot of things. We're talking about the ratio between working, and the number of workers is going down in absolute terms, and the number of people who are not working but still part of the population of the United States is going up. So if that continues, you're going to eventually end up with one person working and 300 million not.
Japan, I remember in the early 90s, after they had their top in 1989, 1990 of the Nikkei and the real estate, uh, and they kept bailing out the banks and like doing huge fiscal policy. And economists in the West were like criticizing them. You have to let things correct. We've been doing the same thing since '08, though. So yeah, I think hyperinflation, like Rafi said, is not fun, but it's probably the best kind of medicine. Is that how you see it, Clive?
Yeah, well, I think it's the plan. I mean, they don't use the word hyperinflation in the plan, but the plan is to inflate their way out of trouble. And they hope that the consequence will not be hyperinflation. In fact, I think, realistically speaking, what they're hoping is that prices won't rise that much, and all that newly printed money will go into asset prices, creating well, obviously helping their friends, the rich, and also, if you like, because there's going to be so much money going into assets, probably boosting the economy. I think that's rather the hope. Obviously, we don't know if it will play out like that, but clearly nobody in government's going to say our plan is to have hyperinflation. They're going to
Uh-huh.
say yes, we'll borrow money, and it'll hope that tomorrow will be like yesterday.
Severe demographic and structural imbalances are intensifying systemic fragility across Western economies. Official labor statistics reveal that while the total population expands, the number of actively employed workers is declining in absolute terms. This creates an unsustainable economic reality where a shrinking productive tax base must carry a growing majority dependent on state handouts. Pensions, Social Security, and healthcare programs. Central authorities continue to replicate Japan's post-1989 monetary playbook by endlessly bailing out financial institutions and expanding fiscal deficits. When hyperinflation takes hold, gold naturally absorbs excessive liquidity and expands in value faster than consumer prices. This purchasing power enables bullion holders to secure distressed assets at massive discounts, while unbacked paper currencies lose real purchasing power. Now let's get back to the interview.
He looks at cycles. He's studied like in the early 90s. He studied and saw that the bond market bottomed, topped, yeah, topped in price, or yields bottom in 1941, and then for 40 years they went up till 1981, and then the next 40 years yields went down 2021. So now he sees another 40-year cycle. That's why he sees 2058. But and that's why he told me he moved out of Frankfurt like 2.5 years ago because he's now living in like a rural farm, and he says I hold physical gold and silver. That's the only thing I hold. So yeah, and he said it's going to be tough because we've had 40 years of easy credit. That's what he sees. And I'm going to just bring it before I ask Clive. I'm going to just, I couldn't get the chart of the Bund going back to 1980 because the Bund changed from being Deutschmark to euros. But I did this on ChatGPT and it's pretty good. So when he told my friend back in the early 90s, you see the Bunds were around 90 or even below 90. And yeah, I mean, this is on a monthly basis. So I think he actually even went up to 180. But yeah, he was right about that. That's why I'm showing you this. So Clive, what's your view on bonds? I know you're not too keen on bonds.
Well, we did see 6.5% yields back in 2000. And of course, you mentioned 1981 when the US 30-year topped out at 15%. So, in terms of historical precedent, 6.5% would not be off the radar screen. It's entirely possible. Having said that, the debt of the United States is considerably higher as a percentage of GDP than it was back then, which means that a rise in rates to that sort of level would be catastrophic for the bond market and catastrophic for the budget of the United States.
Yeah, and I think that's what would probably push them to intervene, but not just the Fed, but I think all the major central banks will do massive QE if that were to happen. And I'm not sure it will work. Thank you for your super chat, attorney Michael Eline. He says 707 in the chat and only 109 likes. Anyway, um, let's see if we got some more. Just bring a few more charts here. Got one. Yeah, it's funny because I was looking at these charts this afternoon, and then this guy called me, which was yeah, he never calls me. Yeah, so that's the 30 year. Um, yeah, it was quite sharp up and down during 2020, and they've kind of contained it for the last 3 years, but it looks like it's taking off. That's why I was surprised when he said 6%, because if you look at here, I could see 6% maybe by the middle of end of next year or so, but not by the end of this year, beginning of the year. So yeah, and then we got the 10 year that hasn't broken out yet, but yeah, this is why they had to do QE. It was so volatile.
We had this recent exercise by the US Treasury to try and save the Japanese bond market, if you like, or the Japanese currency. Actually, they're trying to save because the question was whether the Japanese central bank should intervene or raise interest rates. And of course, raising interest rates further would have been quite catastrophic for the Japanese economy. So the alternative would have been for them to strengthen the yen, to sell US treasuries and buy Japanese yen with the proceeds. But that, of course, would have pushed up the yields in the United States because Japan is the biggest foreign holder of US bonds. So the Treasury didn't want that. So what they did, they basically used some of the euros they got access to. I don't know if it was the Treasury's euros or someone else's euros to basically buy Japanese yen supporting it. But I think it's probably only temporary. And what happens when the yen starts going down again and the Japanese are once again expected to step in and support the yen? You know, do they let the yen slide? Do they raise or do they not and do what they're supposed to do, which is raise interest rates? And if if they don't want to raise interest rates, then they've got no choice but to sell treasuries.
Global foreign exchange stability is under immense strain as international central banks confront unmanageable debt obligations. Recent interventions using European currency reserves to prop up the depreciating Japanese yen highlight severe underlying fractures in global debt management. If major foreign holders are compelled to liquidate massive reserves of United States sovereign debt to defend their domestic currencies, rising yields will severely threaten national budgets. Unlike 1981, when the financial system tolerated 15% yields, modern debt to GDP ratios mean even modest rate increases create catastrophic fiscal deficits. Simultaneously, highly overstretched equity markets present severe valuation risks, where any broad sell-off rapidly redirects capital into tangible assets. Historical case studies from 1980s Yugoslavian hyperinflation illustrate how uncontrolled currency depreciation allows fixed-rate mortgages to be eliminated with a single month's inflated wage, yet completely erases traditional fiat cash savings. Governments consistently choose currency debasement over fiscal restraint, fundamentally altering wealth distribution across society. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.